So what we are trying to do is trying to establish a connection between the dividend decision that the company makes and the value. The classical theories state that there is no relationship. There should not be any relationship between dividend policy and value. But the market imperfections because of the taxes, dividend payout, process of dividend payout, repurchase, stock dividend, stock split, and other issues, there are strong signal. Dividend carries strong signal to the market, which strongly connects dividend policy to value. So we have tested this. This paper published, I think, in a ESCI Index journal back in 2013. And I took data from Malaysian market for 6 years using 361 companies. These are non-financial firms. So there is no bank or insurance company involved here. And we try to take number of proxies. The dependent variable was Tobin's Q. Tobin's Q is a Q ratio, they call it. Q ratio is a measure of performance. And generally this basically measures both financial performance and market performance. So it's a combined performance measurement for company. And we have taken number of variables, independent variables. DPS is dividend per share. This is one of the key variable that we want to check. And also DP out. This is another variable, DP out. So DP out is a size dummy for dividend payment. We use 1 if DPS is greater than median value. So we wanted to see who is giving higher dividend or lower dividend consistently, and whether giving higher dividend is connected to performance or not. So as you can see, the broader result is DPS is positively connected to Q ratio, and also DP out, size proxy of the dividend, is also positively connected, meaning that if someone is giving higher dividend, their market performance is increasing. Then we try to test more using a theory, we call it dividend catering theory by Baker and Ugler, 2004. And this theory basically says that dividend is determined by market performance. Okay, so previously what we did Q ratio performance as a function of dividend, DPS, for example. We want to see DPS as a function of Q ratio. So we want to see whether dividend is market determined or not, whether it is catering to the demand of the market. And we have tested a number of equations for that. I'll show you this now. We tested this equation for number of sample. For the total sample, 361 company. We divided them into trading and services, property, the companies in property sector, companies in consumer sector, industrial sector. And you will see across all the sector, we found that DPS positively influences Q ratio. And we did not do DP out here, we only did DPS. So dividend per share has a positive connection in all the sectors. Let's go on to the next one. Then we try to see for different sector, what is the connection between DPS and Q ratio, whether Q ratio influence DPS. And we found that the Q ratio performance positively influences, and then negatively influences, and then positive again, and not significant, meaning that there is impact. There is impact of Q ratio with the DPS, meaning that dividend per share is significantly catered to the performance in the market. So what is the market perception about the company? Q ratio identifies the signal in the market. So if the Q ratio significantly influences dividend per share, meaning that the market signal determines or influences the dividend policy decision, which is not in the efficient market, obviously. In an inefficient market, when the market is inefficient, this can happen, meaning that company managers decide whether to pay dividend or not, depending on the market forces. Also, we try to see whether dividend per share is influenced by dividend per share last year, T minus 1. You can see T minus 1. So T minus 1, whether dividend last year influenced dividend this year. And we see that there are significant positive and negative reactions. Okay, significant, all of them significant at 1% level, meaning that last year dividend has significant influence on this year dividend. Okay, meaning that company trying to maintain certain dividend policy. The last one we try to prove is whether dividend per share has a connection with DP out. Okay, so whether size has importance, whether whoever company gave higher dividend last year, are they still giving higher dividend this year or not? So it has to be positive. The connection has to be positive. Look at the DP out, meaning that the total sample positive connection, meaning that whoever gave larger dividend last year, they are still giving the larger dividend this year. So all are positive here. Last year larger dividend, this year also larger dividend. Last year smaller dividend, still they are giving smaller dividend, meaning that the company tries to follow a specific dividend policy every year. This has significant impact on value or performance or Q ratio. So what we try to prove is, in the summary, whether DPS influence performance, yes. Whether Q ratio influence DPS, yes. Whether expectation, last year DPS and this year DPS influence DPS, yes. Whether expectation of companies higher dividend using DP out, whether they are connected, yes. So all our conditions met, meaning that dividend per share is determined by market forces. These indicate that dividend is supported by performance. Dividend is supported by market performance. The results show that historical view of no DPS to Q ratio is violated. So classical theory says that dividend per share is not connected to performance, which is not true. So dividend policy is important and carries significant bearing on corporate value and performance. So this is what we try to prove using Malaysian company. So we close here with the dividend policy chapter. Just to have a recap, what we have covered so far in this chapter, we have covered at least 3 sections. We covered at least 3 sections. In the first section, we gave you very basic information about dividend and the classical theory, dividend connection to earnings, dividend connection to performance and others. And in the classical theory, we try to prove that dividend policy does not influence the value. And in the second part, we went to the dividend payout controversy, where we basically discussed about the market imperfections, and we found that dividend decision is significantly connected to market forces, including taxes, including other variables. And at the last section, we tried to show you some evidence using the connection between dividend and valuation in Malaysian market, considering Malaysian non-financial companies. And our summary from this discussion is that whatever dividend decision that we discuss or decide, or company is trying to decide a magical figure for offering dividend next year, it will be significantly affected by how the investors think about the company, what kind of signal the company wants to give to the market, what is the prevailing tax rate in that market on dividend. So number of market-related factors, imperfect factors, will be influencing our dividend policy decision. Okay, we'll close this now. We'll move to the next chapter. It's a very small chapter on merger and acquisitions. Let me open this chapter for you. This is topic 5. I have mistakenly here session 9. It was actually in the previous semester. It was at the latest section. So we'll try to talk about mergers, even though in Brunei market it's very difficult to give example on mergers. So we'll try to take example from neighboring countries and see how merger and acquisition works. First of all, merger and acquisition is a strategic decision. It does not happen every day. No company in the world wants to do merger. Now, what is a merger? In general, merger is coming from the word merge, meaning that 2 companies will work together. Okay, that's merger. Now, acquisition is purchase. when one company purchases another company. Now, there is a bit of trick here. You have to understand it. Merger, generally, merger is not, merger is also an acquisition. That means if one company and another company together, they cannot work unless one purchase another company. So traditionally or typically, all mergers should be an acquisition too. That's why they call this together, merger and acquisitions. The reason why they actually still call it merger, because some acquisitions are friendly merger. Friendly merger can be of two types, broadly two types. Uh, it can be a friendly merger, meaning that two companies sit together, they negotiate, and they happily merge together for a strategic reason. Maybe one company is missing on something, the other company is trying to fill it up, so they sit together and they try to merge together. That's a friendly merger. Now, merger can also happen due to hostile forces, meaning that one company, without the approval of the other company, trying to merge with that company, trying to purchase that company. So when it becomes hostile merger, it generally becomes an acquisition. Okay, it is generally an acquisition. So you are purchasing another company against the will of that company. So merger and acquisition generally does not happen. No company, when they open a company, when they start a company, they do not want to simply merge with another company unless there is a strategic reason. There are a lot of examples of this merger and acquisition. I'll give you an example later that happens strategically. So in theory, there are this first company with their assets and liabilities and owners' equities on the two sides. They decide to merge with the second company. Obviously, the objective is to fill up the gaps. You know, in maybe somewhere in the asset side, you have some problem that your assets are not, helping you to sell properly, to produce properly. Maybe you have some issue with your inventory. Maybe you have issue with your accounts receivable. So you find out another company that is specializing in inventory management. Let me give you a very interesting example that I've seen recently. Volvo, I think you know Volvo. Let me know if my spelling is wrong because I have never driven a Volvo car. Considered to be one of the safest personal vehicle due to their safety features. So Volvo, they have declared that by 2030, all their vehicle they are selling would be electric vehicle. Now, in order to do that, they have to establish a massive infrastructure of electrical charging. Electric car, if you have an electric car, you need to have electric station for charging stations, just like petrol station. In different parts of the country, you need to have a petrol station. Now you need to have electric charging stations. Now this is not a normal task. You need to have a serious amount of investment, and many car companies, those are basically traditional car company like Volvo, Toyota, Nissan, or Volkswagen, BMW. They are not expert of electronic infrastructure. So they want to now purchase companies. Those are specializing in electronic based or electric charging. So Volvo is now in the talk of merging with another company. It's not merging; they are purchasing another company. They basically specialize in electrical charging station supplier. So it's a major supplier in the Europe. It is still in discussion, and in the future, they are going to buy this company in order to facilitate their charging to their customer throughout Europe. So this kind of, this is a friendly margin. These two companies coming together, discussing to fill up some gap. Volvo is one of the largest car manufacturer in the world, or automobile manufacturer in the world, but they don't specialize in certain sector. In order to increase their sales, in order to increase the facility to the customer, they are now merging with another company or purchasing another company that will fill up some gap in their asset side or in the liability side. So it's a strategic decision. You can understand it's a strategic decision. It does not happen every day, and it is obviously to increase the value of the both companies. The merger, this is a trend, US trend. from 1962 until 2013, you can see how significantly merger decision is affecting corporate decisions. It is increasing significantly. Number of deals at the left side, you can see that since 1995, or let's say a little bit from 1998 Asian crisis, you can see the number of merger and acquisition deals almost quadruple, three times, see, four times, more than four times. So it's the average 2,000, and now almost quadruple. It's 10,000 plus, 8,000 plus. So why merger and acquisition deals are increasing? Because there are lots of companies coming up with new technologies, new innovative technologies, but they do not have sufficient funds. So there's a big company that will purchase this small company in order to go on. So you can give example of WhatsApp. You know, WhatsApp was a small company and then purchased by another big company. I think you know that. Skype was similar to that, or something like this. There are a lot of small companies nowadays purchased by Microsoft, Apple, Siri. You know Siri. You use Siri. I think Siri is the Apple's mobile phone, the AI thing that you hear. It was also a small company, was purchased by Apple. So all these innovative companies, small companies, they register and then they are purchased by the bigger companies for strategic reasons. Some are purchased to reduce competitive pressure, and some are purchased to add to the value, existing value of the company. These are some of the big examples in recent years in terms of payment of billions of dollars. The transaction happened during the merger and acquisition. Verizon, I think you know, it's a major telecom company in the US. They were having a merger and acquisition deal with Vodafone, and the transaction happened in the UK, tons of billions of dollars, US dollar 130. Recently, there was another chaos between Heinz. I think you know Heinz. Heinz, they bought Kraft many years ago, but Heinz had an issue recently with Lever Brothers, Unilever. They call it Unilever. They wanted to, I think, purchase Unilever, but at the last moment, the transaction was halted by UK government. So there are a lot of big value merger and acquisition happening. These are all $1 billion, and it means that after this merger and acquisition, the entire sector will be changed basically. For example, in you see there are a lot of merger and acquisition happening in telecom sector. Telecom, this is telecom. You see in telecom also. So it's a sector that is kind of like quite volatile, vulnerable sector. A lot of merger and acquisitions happening. You can click this link at the below here. You can click this link to look at the top 5 biggest deals of the year in 2019, I think 19 or 20, the merger and acquisition deals of the world. Why there's a merger? Why company merge with another company? First, there might be an economies of scale, meaning that with merging with another company, you want to reduce the per capita cost or price per product, price per unit. You want to reduce variable cost, for example. You want to increase your production. That is possibly your objective. So economies of scale is one of the reasons why company want to merge, meaning that they want to, for example, the Volvo case that I told you, if Volvo wants to increase their electronic charging capacity, the per unit cost might be a little bit higher. So in order to reduce the per unit cost to the customer, they are merging with another company that specializes in that sector. Economies of vertical integration. The Volvo's case is exactly like the vertical integration. So you would like to merge with another company that is vertically in the next stage of your supply chain. So for example, Pepsi-Cola had to merge with or had to purchase a company that were producing their bottles. So, you know, bottles for Pepsi-Cola and similar companies, this is the next stage in the supply chain. So first you produce the syrup, the juice that you want to put inside the bottle. The next stage is the bottle. So in order to produce the bottle, the company that is specializing in syrup, let's say Coca-Cola or Pepsi-Cola, they are not specializing in producing plastic bottles. So you need to merge or purchase another company or integrate that company's operation into your simulation line so that you can you can produce bottle, you can control the entire vertical chain. So sometimes the companies merge with each other in order to fulfill that gap in the vertical chain. Let's say I give you an example of UBD. Let's say UBD is taking tuition fee, and it's very difficult to manage the tuition fee submission by the student to bank, and then bank talk to the UBD. Why not UBD has its own banking? You know, it can have its own banking, so that let's say UBD bank or something. So what you have to do is go to that bank and pay your tuition fee. It will be automatically adjusted with UBD's financials. So sometime if you have a bigger amount of transaction, you may consider having this kind of margin, and that is basically the next step of your vertical chain. Next one is combining missing pieces. Okay, so a company has this is an example. A company has all these operations, everything is okay, but they're still missing in some points. The Volvo example can be considered as a missing piece. So in order to reach a specific customer group, you need a specific machineries or a specific process or setup that you do not have. You are merging with another company in order to bring that missing piece to your company. Finally, merger can be also a positive NPV investment. That means when you're merging with another company, it can be an investment, it can be considered as an investment, which is adding value to your existing corporate value. Merger and acquisition valuation. Valuation from merger and acquisition is is quite simple. The consideration is that present value of the both company A and B together must be higher than the individual value of the two companies. So when you are merging, you must make sure that when you will only merge if the value of the two companies together is greater than the individual value of the two companies. So let's say when A and B are planning to merge, the merged value or post-merger value must be higher than the individual value of the two companies. These are some explanation given here, how you decide on a merger decision, that we will decide only when the NPV is positive, where NPV is basically gain minus the cost, how the gain is calculated, the value of the post-merger value of the two companies minus the individual values, and how the cost is calculated, cost paid for the merger or acquisition minus the present value of the target company. Generally, company B is considered as the target company, and company A is considered the acquirer. So let me take you to the previous slide again and explain again. Company A is considered as the acquiring company. Acquiring company, if you remember, the merger and acquisitions are all basically acquisition. So in an acquisition, there are two parties. In a purchase decision, there are two parties. One party is the buyer, the other party is the seller, right? So buyer in finance, in financial language, we call it acquisition, acquirer. So the company A is considered the acquiring company, the company that is purchasing, and company B is called the target company. Target company means is the selling company, seller company. So they are being targeted, they are being purchased by company A. Now, estimating the merger gains, there is an example given here for you. Two firms merge, creating $25 million in synergies. If A buys B for $65 million, and there are costs given here for you to calculate. I'm not going to do through this calculation because these are already done. What I will do is later on, I will upload a small case for you, two small cases for you, and I will upload the solution as well. And those cases will be using similar equation and similar principle, but this will be a little bit broader in perspective. There is another example, the extension of the previous example, how the NPV is calculated, and as long as the NPV is positive, we will accept the merger decision. This is a very classical merger example of Oracle and PeopleSoft. This is to show you how the merger process goes from the beginning to end. In June 6, 2003, Oracle offers cash of $16 per share for PeopleSoft, another company. This is a premium of 6%. So whatever the PeopleSoft stock at that time selling in the market, this $16 was 6% higher than the existing share price. And for a long period of time, almost 1.5 years later, in December 13, 2004, these two companies agreed, and PeopleSoft sold their share to Oracle. You know, Oracle is a large company, one of the largest companies in tech industry. So Oracle raises offer to 26.50 per share after negotiation. So almost $10.50 increase accepted by the PeopleSoft board. So PeopleSoft eventually agreed to sell their company after 1.5 years of active negotiation. So merger and acquisition decision goes through a long, long process. And within this process, believe me, every information comes out about merger and acquisition that will impact the stock price of both companies. So merger and acquisition decision before the final announcement and before after the initial announcement for these 1.5 years, there might be a lot of things happening to the stock price of these two companies. And these information are price sensitive information, and the two companies must be dealing with this information very carefully. Benefits and cost of merger. Who usually benefits from the merger? When a merger happens, who benefits? Shareholder of the target company. Because generally target company is considered to be a smaller company relatively in less beneficial stage than the acquiring company, right? The acquiring company is considered to be a larger company. And this, when a large company is purchasing a small company, obviously the benefit goes to the shareholder of the small company, right? The benefit also goes to lawyers and brokers. And the lawyers get a lot of money from legal battle, because this entire transaction goes through court, goes through a lot of documentation in Securities and Exchange Commission. So there are investment bankers involved, there are lawyers involved, and they make a lot of money. They make commissions out of it. The executives of the acquiring firm. So the acquiring firm, the big company, their executives make additional money because of the success and increase in stock price. Because if this decision is a good decision, the stock price will increase, and executives, the top executives, will sell their company is gaining, then the shareholder of the acquiring company will lose. Okay, because they will have to pay obviously overpayment to the shareholder of the target company. Now, let me tell you why overpayment. Let me take you to the Oracle case. Initially, the offer was $16, but final offer was 26.5. So they are basically giving $10.50 extra per share within 1.5 years. So this is an overpayment that obviously is taken over by the shareholders of the acquiring company. Executives of the target company they lose their job, because when you purchase another company, you can now decide which executive you retain, which executive you fire. So many target company executives will lose their job. All employees will suffer as well, all employees due to restructuring. So in both the companies, the acquiring company and the target company, it's a threat. It's a threat to all employees, because many employees, due to restructuring of their responsibilities, they will lose their job. And they might be assigned to jobs they don't want to do. Okay, so after acquiring, maybe the acquiring company still want to keep you in the job, but they will give you some job that you do not want to do. Okay, so that actually it happened with me in one of the universities previously. Our department was, it became very big. Accounting and finance department became very big. So previously it was a division. So from a small division, it became a very big department. So it was given the status of kind of like a small school, because our student number was almost 2,000 to 3,000 students per semester. So once it was done, I was given with some more responsibility that I did not like. I was given the program leadership plus other responsibilities that I didn't like. So sometimes the employees may not like the thing that is given to them. So the responsibility of the bigger department now is taken by the university, and some of our revenues also from the department will be taken by the university. So our revenues are taken, given in return with more responsibilities, which employees may not like. The takeover method. Takeover means acquisition. So how you are taking over another company. What are the methods available? Okay, we'll give you two examples. One is general example. This one is general takeover methods. Another one I'll give you for the case of Malaysia. I'll take a case on Malaysia and I'll show you some example how Malaysia as a neighboring country, they have stock market and others. So how acquisition happen in that country. Proxy contest, one of the common methods of purchasing another company. Proxy contest is basically when you purchase the company from the stock market. So proxy is basically when when the company asks for vote. The board of directors every year, the shareholders will be voting for selecting the board of directors. So you can, instead of voting directly, you can choose a proxy to vote for you. So when you are selecting a proxy, that proxy, all these proxy may work together and change the board of directors of the company. That is called a proxy fight or proxy contest. So by doing a proxy contest, one acquiring company, if they cannot buy the company directly, they may buy the proxies and can control the company, the target company, indirectly. So one of the ways you can buy a company is through changing their board of directors through proxy contest. Second one is acquisition. No offense to anyone if you are Malaysian, don't blame me. For the last 1.5 years, Malaysian politics was basically proxy contest. So it was the fight between Big Tun Mahathir and the anti-game by Muhammad Yassin, and also now the new prime minister, and also in the opposition was Najib Tun Razak, previous prime minister. So it was a proxy contest. It was not a direct fight between anyone. They were using their proxies, their members, shareholders, kind of like, member of the parliaments to fight against the other group. So even though directly they were saying that Tun Mahathir, we are with you, but indirectly actually it was a proxy fight going on, and it is a perfect example. Even though Malaysian people suffered a lot, we are sorry for that, but this became very similar to a business case proxy contest. Acquisition is a direct purchase when one company acquires the other company. So there will be a bidding offer, and if the company board of directors accept it, they will sell the company to the acquiring company. Leverage buyout. Leverage is debt. Leverage buyout, debt. Buyout. Buyout is purchasing, right? Buyout is when you're buying out a company. So buying out using leverage. That's what they call it, leverage buyout. So leverage buyout is when a company is in trouble, target company is in trouble. So they are looking for leverage. They are looking for debt or fund, extra fund, and nobody wants to give them fund. Okay, they are in some kind of crisis. So your company sees some benefit in that company, and you are giving them leverage. You are giving them some debt or fund, and the condition is we will buy your company in return for this debt. So that is called a leverage buyout. Leverage buyout generally is a very famous contract in finance. In short, they call it LBOs or leverage buyout. One of the major issue about leverage buyout, let me tell you, once this leverage buyout happens, generally the target company's share will be wiped out from the market. Let me repeat. Let's say the target company previously was in the market. Once the leverage buyout happens, let's say company A purchases company B using debt, private debt. So once I purchase your company's share will be completely purchased by my company, and all those shares will be taken out of the market. You'll be delisted. LBOs generally result in the delisting of the target company. Now, the reason why they are delisted, why they are taken out from the share market, because it happens using leverage. So I'm giving my personal debt, which is outside of the company, outside of the stock market, in order to buy your company. So once I use my debt to buy you out, I will obviously, take your company out of the stock market. Next one is management buyout. Management buyout is similar to leverage. Only difference is instead of leverage or the fund, I'm giving my management capacity. to buy you out. Your company has money, your company has all the capacities, but you do not have efficient management team to run your company. So I give your company efficient management team with the condition that we are going to buy you out. We are going to control your company using our management capacity. Next one is merger. Merger is a friendly merger. When these two companies comes together, their objective happens to be the same. For strategic reason, they sit together and decide that they are going to have a merger. And don't forget that merger eventually comes to an acquisition. So it will be eventually purchase of one company by another company, or renaming after the merger. Both company come together and they rename the company into a new company. It can also happen. You can look at the example of Axiata in Malaysia, how they merged from other companies and eventually became a bigger company. Tender offer. And this is actually a technique, it's a tool, it's a method. This is a method of purchase. So you can purchase another company by using tender, open market tender. So you can basically give an open market tender that I want to purchase the company share at this price. So by giving open market tender or even closed market tender, you can purchase another company. Tender offer is often considered as hostile. A large company, let's say acquiring company is a large company, they can give a premium of 100-200% in order to purchase a target company by giving tender offer, which is considered often a hostile takeover. These are the defenses. When some company wants to take you over, you can defend yourself. Okay, you can defend yourself by using many different techniques. You can defend yourself. There are different techniques available for pre-offer defense. Before the acquiring company is offering you to purchase, you can defend yourself, or you can do post-offer defense. The offer has been made. Now what you can do? Okay, I'll take one example each, and you try to finish the rest. Say, for example, let's say poison pill. Let's talk about poison pill. This is a pre-offer defense. What happens here? Existing shareholders, let me zoom in. Existing shareholders have issued rights. Okay, this is a part of stock repurchase. Remember, in the dividend chapter, we discussed about it, but we call it green pill. They call it also green pill sometimes. They also call it green mail, green pill, green mail, or poison pill. So what is this? This is a right. This is a specific right issued to the target company shareholders. If there is a significant purchase of share by bidder means the acquiring company, this right can be used to purchase additional stock in the company at a bargain price. So when you see that your company is being purchased by another company, what you do, in order to discourage the acquiring company, you will issue a right to your shareholder that if the acquiring company purchase our company, according to this right, this is a legal right. According to this right, our shareholders would be able to purchase additional shares in the acquiring company at a bargain price. Okay. Now this eventually may discourage the acquiring company to purchase your company, because if they purchase your company, the acquiring company will unnecessarily have to sell additional share to the shareholder of the target company at a low price, which they do not want to do. So this is actually a good thing in order to defend your company against takeover. So this is pre-offer takeover. What happened in the post-offer? Let's say some company has already offered you, the information is already public, it is in the market. How you can defend yourself? One of the costly process would be long-lasting process. The mechanism is, when a company offer you to purchase your company, your strategy would be to delay it as long as possible. And the best way to delay anything on this planet is to go for litigation. Litigation is to ask for legal help. So you basically will sue the company, sue the acquiring company, and you will delay it as long as possible. Okay, now you might be thinking that if I delay it, what's the benefit? The benefit is, look at the Oracle. Oracle and PeopleSoft company delay only 1.5 years. Sorry about that. Where is it? Oracle and PeopleSoft delay from 2003 until 2004 December, June to December. So 1.5 years delay. And within this delay, the stock price increased from $16 to 26.5. Meaning that if you can delay using litigation, it would be gradually very difficult for the acquiring company to acquire you. So Target files lawsuit against the bidder for violating something. You'll find out something, antitrust law or whatever it is. You find out something to sue the company, and this legal help you are taking only to extend your time, because maybe you are sure that eventually you cannot stop this acquisition. This big company will eventually purchase you, but if you can delay this longer and longer, your shareholders will be benefited. Your employees will get much more benefit within this time period. And the more time you get, you can negotiate more with the company. So one of the costliest for acquiring companies to have when the target company has a litigation process. You can also restructure your asset. You can start selling your good asset, purchasing bad asset. That may also discourage the acquiring company to move away from this purchase. Okay, let's now quickly go into a case to give you some example of how merger and acquisition happens in Malaysia. We take an example of 3 companies, Kumpulan Sime Darby. I think you heard about Sime Darby, is a big plantation company in Malaysia. Golden Hope, it was previously also another big company in plantation. And Guthrie was also a plantation company. So they decided to merge together to become a very large company to make plantation sector in Malaysia very strong. This happened in relation to the competition offered by the Indonesian plantation company. As you know, that palm oil plantation is very competitive in Indonesia and Malaysia, even though Indonesian plantation companies are very strong. So they in order to protect the Malaysian companies, they initiated this merger. Merger and acquisition takeover in Malaysia happens in horizontal takeover. This is between companies of the same space. So if you are companies from the same space, you can do horizontal takeover. Vertical takeover will be happening if you are in the vertical chain. So between companies from different stages of the same finished product. Remember the Volvo example, that Volvo needs an electric station as well for their cars to be charged. So it is in the same vertical chain. So therefore, they can merge with another company or take over another company. Next one is generic merger, is between companies from same industry but with different product. Same industry, in the electronic industry, but let's say with different product. One is doing with let's say iPhone, and another one, let's say with something else, producing chips or electronic chips or something. So it's in the same industry, but with a different product line. The next one is conglomerate. Conglomerate is a big one. Is between companies having nothing in common but big companies. These are unrelated mergers or unrelated acquisitions. They have nothing in common. They are coming completely from different industries and acquisition happening, but merger happening between these 2 companies. Reverse takeover is between a private and a public company. Now, generally, normal takeover is a public company purchases a private company. Let me repeat. Normal takeover, normal purchase is a public company is the acquiring company. Public company means the company that is publicly listed in stock market. So a stock market listed company, public company purchases another private company. This is the normal takeover. A reverse takeover is opposite, when a private company attempts to buy out a public company. Okay, so reverse takeover can also happen in Malaysia. There were a number of examples. So I have taken this study from Fauzias Matnor. That was, I think, the survey was done quite long ago, but it still gives us some idea of what are the reasons behind merger in Malaysia. So even though major reason is not identifiable, that means the managers do not want to identify. what is the specific reason. That also shows that merger and acquisition is a strategic decision that the managers do not want to, simply publicly say what is the reason behind this merger. But a big reason is diversification. That means one company wants to diversify into another sector. So they are 52% of the mergers happen because they want to diversify their company interest into another sector. So they also have merged with another company because of enlarging company's capacity to supply some other markets, supply old markets. And they're also lengthening the product line. So they're expanding the product line, increasing new products to the product line. Therefore, they are merging with another company. So merger and acquisition in Malaysia happen mostly for diversification interest. Okay, now we'll look into something called announcement effect. What is the effect of merger and acquisition on stock price? So announcement of merger and acquisition supplies new information about the companies involved in the market. So it gives a signal that announcement can carry significant impact on the stock price of both target company and the bidder company, the acquiring firm. It can happen pre and post announcement stock market performance. So pre-announcement, there might be some impact, just that there is a rumor in the market and company just publicly announce that something is happening. So there are some differences between pre and post announcement. This must be publicly announced that you are purchasing a company. It must be publicly announced. So before the announcement and after the announcement, there must be significant difference in stock price. And we do this investigation using an event study. Announcement is considered as the event. And before the event, what happens to stock price? And after the event, what happens to stock price? If there is a significant difference, then we can say that this merger and acquisition announcement has significant influence on stock price. We calculate abnormal return, the return that is earned above the market return, as called abnormal return or arbitrage return. We calculate this and we try to see what is the difference in abnormal return pre and post merger. The objective was to investigate whether announcement effect influences abnormal return, whether there is additional return or abnormal return or arbitrage return earned before the announcement and after the announcement. I took this example from the professor published in Malaysia. This was the most robust study available at that time. So this is the setup of the testing. Sorry, it should be event. Can you make it event? It is an event study method. So they have taken a time frame from minus 200 days to plus 200 days. 0 day is called the announcement day. Okay, 0 day is the announcement day. So before 0 day for minus 200 days would be pre-announcement. From 0 day to plus 200 days would be post-announcement. Pre-announcement, post-announcement. All announcement by bidder firms between 1977 and 1989 was considered for this study. So it's a big sample they have considered. I have done actually a similar study, but I could not publish it because I did not finish the study. I did my study took sample from I think 1979, just 2 years later, 1979. I think until 2016 or 17, I included in the data set because I got this data from a very unique data set, but I could not finish the data. But overall, I received similar results. So I can agree that their results are quite robust. Day 0 is the day of the announcement, first registered as a press release. You see, you have to publicly announce from the bidder company. Bidder company is the acquiring company. So acquiring company will do a press release that they are going to purchase another company, and that announcement day is considered as a 0 day. This is a 0 day announcement day, and we are going to see what happens before and what happens after. This is the target company stock price. This is the bidder company, acquiring company stock price. This is the 0 day. Remember the announcement day. This is the pre-announcement day. And this is the post-announcement day for both 0-day, pre-announcement day, post-announcement day. Okay, now 200 days each in two directions. So there are 401 days total, 200, 200, 1 day, 0-day. So total 400 days considered, 400 trading days, 400 trading days, meaning that on this date, company's stock price was traded. So if you consider now the impact is, if you can see that until the announcement date, the target company stock price, initially it fell, then it went up. Okay, after that, it has been volatile, but relatively less volatile. It was still at a higher position than the initial stable period. Okay, now you can relate this discussion with this slide. Let me show you. Okay, now who usually benefit from the merger? Shareholder of the target company. Target company means basically the one that we are discussing now. This is the target company. Stock price of the target company in terms of, this is abnormal return. This is cumulative return. So you can obviously replace it in terms of stock price as well. The return is, this is the zero abnormal return. Previous, before the announcement happens, the company was in loss. When the announcement happens, company abnormal return for the investor goes up to 10%, goes up to 20%. Yeah. So it did not go up to 20%, almost 15% was the abnormal return. And the lowest period within the next 200 days was up to the period is still almost positive abnormal return because of the announcement, meaning that the target company benefits from the acquiring decision or acquisition decision, merging decision. The target company shareholders benefits from this decision. Okay, now what happens to the bidder company, acquiring company? Their acquiring company, the cumulative abnormal return here is 0. So in general, when the announcement happened, before the announcement, there's a long tail, meaning that some rumors in the market already available, and stock price sharply went up, giving only 5% of abnormal return. Oh, sorry, 9%. 9% of abnormal return. But for target company, the abnormal return went up to maximum of 15%. So 6% extra abnormal return for the target company. Now, when it went up very sharply, you see it's very sharply increasing, and immediately after the announcement, 0-day, after the announcement, when it all became real, stock price immediately very sharply went down, meaning that many investors lost money, and the cumulative abnormal return reached to 1% again within 200 days. Whereas the cumulative abnormal return for a target company was somewhere, I think, in the range of 2 to 3%, even after 200 days. So meaning that, the bidder company, acquiring company, generally the shareholders of the acquiring company loses from the acquiring decision or acquisition decision. So this is the impact of the announcement only. We are talking about announcement only. Another thing, not all the announcement will eventually be a transaction. Be careful. Your company is announcing a merger with another company. It may not eventually be a final deal. That means your company may not finally take over the company. Okay, so target company may not be eventually purchased by the bidding company. So this impact that we are trying to show is only announcement effect. Okay, announcement effect. The real effect might be different. If the company is really purchased, the real effect might be different. Okay, so what we are concluding here, there is a significant impact of the announcement of a merger and acquisition decision on both the target company shareholders and the bidding company shareholders. Okay, let's conclude this chapter here. What we have done so far, we have talked about three information. First is the basic information about mergers, especially why do company merge, and we have also shown you the reason from Malaysian case also, that almost 60% Malaysian merger is because of diversification. Then we have shown you some calculation briefly, that this is the way merger and acquisition gains are calculated, and I owe you two cases, or at least one case with solutions. And then we have shown you information on the channels of merger and acquisition or takeover process, and also takeover defense mechanism. Then finally, we come to the case, the Malaysian cases, where we have shown you how Malaysian companies exercised their merger and acquisition decision, and what is the impact of those decisions or announcement on the stock price of the target company and bidding company. This is what we so far done, and once again, I owe you one or two cases on merger and acquisition on how to calculate or how to evaluate the merger and acquisition decision given certain information to the shareholders. I will try to upload the solutions and the case as usual on Canvas, and please try to go through those, and possibly we will include if we can or if we want to later on in test 2. Okay, I will give you a very brief, we are not going to cover anything today, but I'll give you 5 minutes brief on what is our next chapter or the next section of the topics. As I told you at the beginning of the semester, the next part, that is basically international finance, would be a little bit matured part, a little bit complex considered to the previous part. So I consider that you would be serious in the class. Many chapters would be a bit lengthy. The reason they are lengthy is because I tried to, because the textbook is actually not available. The library, actually, I have asked them to buy, but I'm not sure when they are going to buy it. And then this lockdown came, so it's actually very tough for them to buy anything right now. So therefore, you will have to rely on the topic that we are going to discuss in the class. And that's why I try to include as much as possible, so that you are not, feeling the lack of discussion. Among these topics, at least there are two topics that will be important for our class test. These two topics will include some decisions regarding financial decisions regarding investments. And as I told you in the first class, if you still remember, the reason why we included this topic, because SCCA asked us to kind of they did not ask us, they actually follow a completely different setup for strategic financial management, but we follow a different setup. So that's why we wanted to redesign the course, keeping the content same, but we wanted to expand the topic to international finance. And I was really feeling sorry that many of your senior friends did this course before, but they did not do international finance. Okay, in the first chapter of international finance, what we'll be dealing with is basically we will talk about multinational financial management challenges. I will give you an example later on for 5 minutes, and then we'll close for today. A big part of the first chapter will be on monetary system. So we'll try to discuss about how the exchange rate came, how your paper money, the Brunei dollar that you see, how it came. Previously we had bartering system, gold system, and how gradually we come to the Brunei Darussalam currency, or let's say Singapore dollar, American dollar. How we came to this currency system. We'll talk about this. A big part of this discussion in the second part of our semester will be actually on currency system. The third part, we will talk about balance of payment. Balance of payment is really very important for us to understand the macroeconomic scenario of a country. If you consider the balance sheet as the performance indicator of a company, balance of payment is the performance indicator of a country. If you look at balance of payment of a country, you'll be able to know whether the country is working well or not. So it's kind of like a performance measurement of a country. So in the first chapter of international finance, we look into the macro issue. These are the macro issues that impact our financial decision. Even though you are a company, your financial decision, your investment decision, your financing decision will be influenced by number of macroeconomic factors. These are the factors we'll discuss in our first chapter. Let me take another 2-3 minutes before I give you the example. In the first chapter, the reason why, actually my example is related to this slide, so I'm covering this. According to Narayana Murthy, he was the president and CEO of Infosys, one of the largest IT companies in India, and also one of the largest IT companies in the world. I am not 100% sure, but if I am at least 90% correct, he is the father-in-law of the current finance minister of the UK. So big guy, he's a big shot, kind of considered as a guru in India, in the IT sector, also in financial sector. Well, he said that the international finance became very important for us because of the word globalization. Now, this globalization, according to him, is producing where it is most cost effective. So you need to move eventually to a country where you can produce goods and services at a low cost. You will sell where it is most profitable. You can earn the most bucks from your selling. And sourcing capital, if you need capital, extra capital, you will be sourcing capital where it is the cheapest. And the number 4th factor is without worrying about national boundaries. There are 4 things here. First, cost-effective production. Second, profitable selling. Third, low-cost capital. And 4th is no restriction in the border. If you can relate this definition to, for example, Eurozone, recently because of Brexit, now there are a lot of problems. I think you now heard that UK is going through first the gas crisis, then the oil crisis, all are partly because of their international decisions with US and Australia to get into, to bypass France for the nuclear decision. So all these political decisions have economic consequences out in order to drive the petrol lorries to reduce the cost. So there are reasons. If you look at the Eurozone, you'll find that this is perfectly working, where within the Eurozone, companies can actually find out places to produce things at low cost. There are many countries coming to countries like Vietnam, Bangladesh, China, because the cost of production is low. And they will also sell to the countries where they will be able to earn most profit. And they will try to source capital from countries where it is the cheapest. Cheapest capital is still available with the US. So they will go to the US or European countries or Japan to source capital that will give them cheaper capital. And obviously they will go to countries or region where there is no national restriction. There is no international restriction. They can easily move between countries. One of the reasons why UK is now suffering, because due to Brexit, they are basically cancelling the visas given to the lorry driver carrying the petrol into the US, into the UK. Therefore, they are now suffering. So you can see what is the influence of free movement, which is the benefit of globalization. So we'll talk about all these factors in the second section of our semester of our course, and there'll be a lot of important discussions, sensitive discussions. I will request you to keep everything inside the classroom. The example that I wanted to give you, actually, I gave you just now, but you can extend it. For example, I always give the example of ready-made garments. The dresses that we are wearing coming from different companies produced in China. They are producing ready-made garments in Vietnam, in Bangladesh. Um, my country is Bangladesh. If you go to Bangladesh, you will see there are separate sections of the city only for production and marketing of ready-made garments. So many expensive brands that you are using, these are basically coming from factories in Bangladesh. So Bangladesh is considered as the second largest producer of ready-made garments after China, even though the percentage is very low. China's production is almost 40%. Bangladesh is producing around 6.5 or 6.7%, whereas very close is Vietnam, they are around 6.2%, I think. So it's kind of like interesting to see how companies coming to these countries to produce. These are big brands like Walmart, CKs, and big posh brands coming to these countries. The reason they are coming to these countries because they want to reduce the cost of production, and these countries generally offer very low cost of labor, very low cost of labor. The T-shirt that you buy, for example, for $10 to $14. In Bangladesh, I can actually produce the same thing for you at $3 to $4. The final product is $3 to $4. So you can actually import ready-made garments from Bangladesh and sell it in Brunei at a very high price. So the internationalization happens because Bangladesh also gives a lot of benefits to the exporter. If you are exporting, there are cash advantage given. There are a lot of tax holidays given to the garments manufacturing companies. And government also sometimes close their eyes if these garments manufacturers not paying their employees on time. There are a lot of protests going on about these issues. You don't see protests in Vietnam or China because government is very strict and they generally suppress these protests. But in Bangladesh, it's still a democratic country where election happens. So government cannot simply suppress all these protests. So there are a lot of issues happening, but still companies choose these countries like Brazil and others because there are absolute advantage in terms of labor cost or natural resources. There is entire region is still not covered by these multinational companies. This is Africa. In Africa, you have natural resources, you have energy resources, especially energy resources, and also you have cheap labor in Africa. So next century, the way Asia is becoming volatile, next century may belong to Africa, in African countries. So we'll discuss about all these potentials of different countries, opportunities created by different countries, and also challenges faced by different countries while they are facilitating international transaction, while they are facilitating globalization for companies to operate in their countries. Taxation can be a major challenge. There are labor unrest, major challenge, political instability, major challenge. One of the reasons why Vietnam, Bangladesh, China, they are doing good is that the political stability in these countries. No major political unrest in these countries over the last 10, 15 years. Can you imagine Bangladesh has been growing at almost 7 to 8% GDP growth per year for the last 10 years. This has been amazing for a country that was growing only at 3 to 4% before that. So Vietnam, same example, if you go through their country political stability report, it's quite stable country. China is stable because of the regulation. So you can see that the companies try to go to those countries where political stability is there. So you will understand why your country is not receiving a foreign investment. It's not because of political issue. You don't have any political issue here. Brunei is quite a stable country and financially strong as well. But possibly your country is quite small, so neighboring countries are quite small in terms of market size as well. Therefore, possibly due to product specialization, you are not receiving foreign investment. You are receiving foreign investment in petroleum. You are receiving foreign investment in refinery, as you can see the Hengji is doing in the island. But you are not receiving other foreign investment in general fields because still the country still has to go a long way But obviously, political stability is a very positive thing in this country. We hope that in the future, there'll be more foreign investment coming to Brunei in financial as well as in non-financial sector. Okay, we'll close here today. We'll inshallah continue in the next class from this chapter. And again, I request you to have an open mind when you are doing these chapters, because again, there'll be a lot of sensitive discussions about number of countries. There'll be a lot of things that you may not like. We'll not talk about Brunei because Brunei is a very small context for our consideration to discuss globalization. We'll talk about China, we'll talk about Singapore possibly, and other countries, and we'll give evidence. Those are publicly available evidence, but still there are sensitive issues. So keep an open mind so that we can have a open discussion on different topics. Okay, thank you very much. We'll see you in the next class. I want to ask for a personal favor. Those of you, my wife is selling a car, so if you think that is there any way you can help me, send me a message. If there's any way you can help. So it's not helping me actually; it's helping possibly somebody else. So let me know if you are in the business of globalization of car selling. You might be purchasing car and selling. Who knows? Many of your friends do that. I had a student previously who did that. He used to buy car from Malaysia and used to sell here, but a different arrangement. It's like a legal tender, purchasing from Japan and selling here. Anyway, so if you're interested, let me know. Send me a personal message to Canvas. I will try to come back to you as soon as possible. And if you have any question regarding these topics, if you want to share any interesting issue about globalization that is affecting small businesses in Brunei, just the last statement that I want to make before we go today. Globalization is all beneficial for many companies, but globalization is a major threat to many countries, including small and medium enterprises. When you want to establish your own entrepreneurship, your own small company, large companies from neighboring countries possibly may come into your country and possibly create a lot of competition for you. So it can be a huge challenge for the government, for your government to safeguard your interest. So globalization can be a very good thing. You can source your capital from outside, you can bring raw materials from outside, you can go to another country and sell, but it might be competitive as well, because there are other countries, those are producing things at a low cost, can come into your country without barriers, without borders, and can sell product. All the best to you, inshallah. See you in the next class. Assalamu alaikum.